Hey everyone, welcome into our January market commentary. We're finally in 2025, leaving 2024 behind. And what we are up to today is we're about to give you guys some insight into what we see happening in the market, what happened last year, how that transitions into next year, and what we're looking for in the next year. Just a quick update for everyone who has been watching these religiously. I know there's a handful of you guys that have been watching these every month. We are transitioning to an every other month cadence for the market commentaries just to make sure that we can pack these full of good information and not have them be too fluffy. So, not that you should be making any changes once a month in your portfolio anyway. So we figured every other month is a good cadence for that. And if anything particularly out of left field happens, we'll try to get another video out for you. But that does not mean we're snoozing on our YouTube channel. We're still getting out a lot of shorter form content there. Neil's been putting a lot of those together. So stay up to date on the YouTube channel, be subscribed there. But these market commentaries will only be once a month from this point forward. So, for those of you that have been with us for a minute, you might notice a new face on the call today. We are joined by Evan Radin. Evan is the newest advisor addition to our team. We feel very lucky to have scooped him up and added him to the team here. So, um, we've also got,
Welcome, Evan.
yeah, welcome, Evan. Thank you
And
Thank
you
you.
for
also
Very excited to be here.
very happy to
very
have you.
good. And you also got me.
Yeah, we've also
It's
got
it's a
Neil.
it's a three-way team split here. So this is the first time we've done this.
There's a first time for everything. I think this is first of 2025 is a good time to do it.
I'm excited. I'm excited. Well, welcome, Evan. We're really pleased to have you. Um, if I'm not mistaken, Evan, you've got the first data point for us for the new year.
I do. I do.
That's right. Evan, get us
What
started. Tell us about what's going on right now.
Definitely. What better place to start than with the S&P 500? So what this graph is showing us is that even through unprecedented times, the S&P 500 has been charging through. So through COVID, there was a big correction, but ever since then, up and up and up. A little bit of a correction when Russia invades Ukraine, but again, up and up and up. And then even with this eventful election, we still have seen that the S&P 500 has continued to show growth. So there's two different ways to look at this going forward. So the overall thinking with consumers out there is that confidence is very high. It's the highest that it's been in the last 30 years, which is kind of ironic because the golden rule of investing is buy low, sell high. And with S&P 500 at almost all-time highs, you would think that maybe this would be a good time to get a little bit more conservative and that maybe the stock market isn't going to continue to show this growth that it's been showing. But according to consumers, that's not what they're feeling. And to show how we've got to these all-time highs, it's been mostly the Mag 7, the Apples, the Amazon, Google, Facebook, Microsoft, Nvidia, Tesla. That's been the big bulk of the S&P 500 growth. So if you look at the chart on the left, the green represents those Mag 7s and the blue represents the other 493 stocks that are in the S&P 500. So you can see that dramatic difference of how the Mag 7 has pulled the S&P 500 up over the last 3-4 years.
Yeah, one thing to
Incredible.
pitch in here, Evan, on that chart up on the left is when you look at the not just the returns, like let's look at 2024, right? The Mag 7 was up 48%. The rest of the S&P 500 was up 10%. And a lot of people, especially if you're looking at the C fund and the TSP or you're tracking any, just the S&P 500 in general, you're looking at this return, this 23% return in the S&P 500 and you're saying that's great. But did you know that 55% of that return has been coming from only 7 companies? So that's pretty wild to look at here when we look at this chart. Well, we had some technical difficulties at this point in our original presentation, so it'll just be me here for a couple slides before Neil and Evan join back in. But what we want to focus on here, on top of just the disparity in returns between the Magnificent Seven and the rest of the market, is how much those returns are contributing to the returns of the S&P 500. I mean, if you look at years 2023 and 2024 here, and if you've been investing these years and you're looking at the C fund or you're looking at the S&P 500 index, you're seeing a 24% return in 2023 and a 23% return in 2024. And it seems like the entire market as a whole is doing very, very well, right? Until you dig a bit deeper and you see that the 493 other companies in the S&P 500 outside of the Magnificent Seven did 8% in 2023 and 10% in 2024, not even half of this actual S&P 500 return. And when we look at the return on the Mag 7, 76% and 48%, we're seeing that these 7 companies accounted for 63% of the returns in the S&P 500 last year, or in 2023, and 55% in 2024. So a massive percentage of the gain, the overall gain that we're seeing in the S&P 500, is coming from these 7 companies. Now, that only tells one side of the story, right? We're seeing the price increase. Well, how are the earnings doing of these 7 companies that are blowing everything else away right now? Well, this chart over here on the top right shows the Magnificent Seven earnings in green, or earnings growth, and the other 493 companies here in blue. And what we can see is throughout 2024, we saw this decline in earnings growth in the S&P or in the Magnificent Seven. Okay, yes, earnings were incredible at the beginning of the year, but they were kind of declining, and now the assumption for 2025 is that they begin to level out and remain steady. Now, what are we getting from the rest of the market? The rest of the market actually started off 2024 very weak. We were nervous about recession here in 2024. And really, the Magnificent Seven helped pull the market out of that. Now, as we go through 2025, the assumption is that the rest of the market is starting to actually increase in earnings growth while the Mag 7 is leveling off. So you could look at this a couple different ways. You could say, oh, the Mag 7, is slowing down, things like that. Or we could look at it and say, well, actually, the rest of the market could be coming up and finally pulling its weight here and contributing to the growth of the S&P 500 in total. But to focus here in another area of concern is what happens, right, when the consumer confidence is so high, like what we were talking about before, and there's this subset of companies that are outperforming everyone else. Is everybody wants to be in the market, but they're only seeing growth happen in one place. So guess where everybody's putting their money? They're putting it in those top performing companies, which happen to be the 7 to 10 largest companies in the US. And so what has that led to? Well, it's led to the prices of these companies increasing to astronomical levels faster than their earnings can keep up. Okay, so what does that look like? Well, now we've broadened out. We're looking at the top 10 stocks in the S&P 500 by size. But first, we're looking at these Magnificent Seven. Now we've broadened that out to the top 10 companies. Now, when we look at the S&P 500 or the C fund and the TSP, there's kind of a misconception out there that the S&P 500 is the top 500 companies in the US, and that it's just spread out, and that the index is just spread out evenly amongst those 500. So you get kind of the average of what those 500 companies do. In reality, the S&P 500 or the C fund and the TSP is a market cap weighted index. That means it's weighted by the size of the companies. So the larger a company is, think Apple, $3 trillion company, Nvidia, $3 trillion company, they make up an outsized holding in the index. So when one of those companies moves, the index will move more in proportion to that company's ownership. So what does that mean, and how does what's happening right now impact that? Well, because so much of this growth has been concentrated in the 10 largest companies in the US, what's happened is those 10 companies have begun making up an outsized proportion of the index. And we've gotten up to this wild level of the top 10 companies in the S&P 500 are now making up 38.7% of the index. Almost 40% of the S&P 500 is only in 10 companies. There's 500 companies in the index, but 40% of the index is only going into 10 companies. So what we're seeing in the S&P 500 is the index is moving as those 10 companies move because they make up such an outsized piece of the index. Now, again, that doesn't tell the whole story. This isn't necessarily worrisome on its own if the fundamentals of these companies are really sound. But what happens when everybody in the market is pouring their money into a small group of companies? The price is increasing based on supply and demand. There's more people wanting to buy than there are sell. Um, but the earnings of those companies aren't quite keeping up with the demand, and so the price is increasing on top of the earnings. Okay, so how does this play out, or what are we looking for? Well, if you've been watching these webinars, you've heard us talk about price to earnings multiples. And what this means is when we look at a price to earnings multiple, we're looking at what is the price for every dollar of earnings that a company is generating. Okay. What price are we paying for every dollar of earnings we're generating? So that's a way to look at how expensive a company is in relation to how much money it's making. Okay, so the lower the index, the cheaper a company is, the lower the ratio, and the higher the ratio, the more expensive it is. You're paying more for every dollar of profit that the company's generating. So on average, if you look back over the last 50 years or so, the S&P 500 averages about 16 times price to earnings. That's what we've decided is about a fair value. Usually we bounce around 16 to 18 times is pretty normal. Well, right now the S&P is trading at 21 times, so that's a little higher than normal. Some reason to be skeptical of that, okay, but not too far out of bounds. But look at where these top 10 companies are trading right now that are controlling 40% of the index. They're trading at 29.8 times price to earnings. Okay. So they're trading significantly above their long term value. And it's not abnormal for the top 10 companies to be higher than the rest of the market. Okay. But they're still, even this, they're trading about 30% above even that normal range for the top 10 companies in the market. So what this means is either the earnings of these companies are going to have to continue to accelerate at a very fast pace, or the price is going to have to come down to get back to this normal level where that we've seen to be sustainable over time. And we're not saying it's impossible for these earnings to increase, but what we're really looking at is that going to be feasible over time? Will these companies be able to keep this valuation? Right. And when we look back at history and how the market typically does at various price to earnings multiples, what we see is there's a pretty good correlation here, especially over 5 years. Okay, that the higher the price to earnings ratio is over the further to the right, the lower the return is over the next 5 years. Okay, the further you get to the right here on this chart, the higher the price to earnings, the lower the return over the next 5 years. Right now, we're trading here, which if you use this chart would mean the S&P 500 is only, you know, assuming a 5% or so a year return over these next 5 years if we can't get these prices back to a place that makes sense. So this
It
all
it
sounds a little bit, Debbie
seems
Downer.
a little bleak.
Yeah. And we don't want to do that, right? And we're not saying to run and hide from the market right now. It's absolutely not what we're saying. But what we're trying to make the case for right now, very strongly, and we're going to say this in different ways, is diversification matters, right? Not having all
Right.
of your eggs in this one basket that looks a little expensive right now matters. And so, Neil, let's look at a few of these other pieces of the market and see where we might be able to find some value.
Yeah, well, going with the theme of kind of what we've been telling clients, really through the probably last 6 to 12 months, right, is we're concerned about the expensive areas of the market. Morningstar provides kind of a box here for us to look at each category in terms of overvalued, undervalued, right? We're seeing the largest overvaluation come from large cap growth, right? Where we're starting to see some areas of opportunity open up is, dare I say, somewhere in the small company range, right? Especially on that value side. So we aren't necessarily telling clients to avoid the markets, but it's to be careful about overexposing yourself to the most expensive areas of the market because, as we've seen from a historical standpoint, those are the sides, the overpriced sides are what gets hit the worst when markets start to contract. We don't know exactly what when that will happen, but we definitely don't want to be too far into that trade if there would be a disappointment or shock to the economy. So this doesn't necessarily give us a necessarily a playbook, but at least gives us an understanding of what part of our portfolio do we want the most exposure to, or the least exposure to, and this gives us kind of that understanding. So as we go out to this next slide just kind of gives you a comparison, just really narrowly focusing on the large cap space. If we take the top 10 growth stocks that are in typical, let's say, US large cap growth funds, and we take those 10 stocks led by NVIDIA, right? And we look at the average price to earnings ratio across those, we're in the 40s. As Austin just mentioned, the average price to earnings ratio of the market going back to 1996 is 16 times earnings. So you're paying, double than what you would normally pay on just the average market's PE ratio. So the concern there is, are these attractively valued? We know they're good companies, but are they attractively valued at this juncture? And we would argue that some of these are definitely carrying valuations that are just mind boggling. If we look at Tesla, 102 times earnings, that means you're paying literally $100 for every $1 of their profit. That's not sustainable. A lot of that's coming off the Trump trade that started surging as soon as he was declared the president elect. We don't see that being sustainable. So we look at the other side of the market, the less uh, call it sexy side of the market, and we look at these companies that have great earnings history, really good earning companies that provide great revenues, led by Berkshire, going down to Home Depot, Walmart, Bank of America, Coca Cola, all these companies, right? Look at the valuation of those 18 times earnings. That's way more in line with where the market's normally been. So that's how we are expressing our portfolios, right? Through some of the less pumped up valuation companies, right? That's why we're gravitating towards indexes that instead of surging in price, we look at the revenue that those companies are providing, which there's no mystery to our top holding. It's the S&P 500 revenue index fund. Why? Because we want to gear towards companies that are providing revenue as opposed to just expanding in price multiples. So as we kind of look at the other areas of the market, the areas that often get left behind, we look at the large cap space, which is represented here in this chart by the large cap uh, uh, S&P 500, which we've already talked about is 40, almost 40% concentrated to just those 10 companies. But then we look at the S&P 500 600, sorry, the S&P 600. This is actually a benchmark for the small cap companies. It's for what it looks like. It's not. It doesn't mean that we're just adding the 100 companies onto the S&P 500. It's a completely different benchmark, and it's a benchmark for the top 600 companies in the small cap index. And what this kind of shows us is the valuation, um, essentially, differences in both of these indexes. So we will notice that the last time there was this big of a discrepancy in the valuation of large cap to small cap, it coincidentally points us right to the 2000 .com bubble. All right. There's a lot of differences between this time and that time. The companies that represent our large cap space are way more profitable and have better outlooks than what were in the 2000 space. But it's oddly similar, right? There is a massive outperformance of large cap over small cap, which is now spread the valuation to be tilted way more to um, large cap. And from a price to earnings standpoint, it's concerning. It's concerning on the large cap side, but it's also reflecting potentially an opportunity on the small cap space. So, as investors are chasing profits on the large cap space, they're basically maybe neglecting an opportunity on that small cap space, which is represented by the green line, and buying some more attractively valued companies as opposed to buying in at 21 times earnings on the S&P 500. So that's what we see in terms of small to mid cap. We're seeing a lot more attractively valued companies there. We're also starting to see some opportunities in the international space. So the international space is very tricky. When you look at really the global index funds and international funds that are out there, there's exposure to Europe, which has been beaten down because of the issues in Ukraine. We also have some issues that are arising in China, right? All of that gives some negative exposure that we've seen, and we've started to see the international space in terms of a price to earnings discount versus the US markets. We haven't seen this level of opportunity in over a decade, right? We've got data that goes back to '04, that's 20 years, and we haven't seen international trade at this much of a discount to the US in a long, long time. So the question though is, guys, when does this break? When do we break trend here? When does international start to rally where the US markets start to maybe become a little more lackluster? And it's really a question of looking back in time and looking at the other areas of the market. Now, it's difficult to kind of see this if you're using a smaller screen device. Correct me if I'm wrong, guys. We question whether we would put this in the presentation or not, just because of how hard it is to see. But
Mhm.
if you'll notice, what this is showing is it's showing the different asset classes that you have, the main asset classes: large cap, small cap, high yield bonds, emerging international equity, developed markets, in terms of developed market equity, which is international developed markets, fixed income, which is bonds. And it's showing you over time which led the charge and which fell short. if we look at 2024, there's no surprise. Large cap US equities led the charge at 25%. The next asset class underneath that is small cap at 11%. That's almost a 15% differential. It's hard to actually see that going back in history, that big of a drop off between asset classes. So if you're looking at a diversified portfolio that's going to take in, 40% bond and some of these other asset classes in there, that means if you're only looking at large cap US as your benchmark, you're going to be potentially disappointed in a diversified account because a diversified account last year on a 60/40 only got you a 10% rate of return, right? And we have a lot of clients that question that trade off between just staying invested in large cap. Large cap US markets is not a benchmark for someone that is, let's say, within 10 years of retirement. It's really an asset allocation mix because there is a lot of concern in that large cap space. And if you're using that just as your guiding light to what you should be expecting in your portfolio, you're setting yourself up for a very rocky potential next 5 years if you're just solely looking that as your benchmark. So that's why we, as a firm, are asset allocators. Now, do we favor US large cap space? Of course we do. But we're being very careful about chasing those just 7 to 10 companies. And that's kind of been the theme all across 2024 and really our kind of guiding light there. Any other things to add, guys, on this chart or any of the other charts I talked about?
I would just add that this chart shows the benefit of diversification, where you see all these different colors going up and down throughout the years, but that asset allocation in the middle stays a little more balanced than the rest. The ride is a little bit smoother, and one step further than that, we can get even more diversified between the asset classes. Where in large cap, there's two different categories within the large cap. There's the growth versus value. So even within the large cap, we got to be diversified between those two.
Mm, yeah. Yep. Exactly right.
Agreed.
And Evan, I think you were going to take this next part too, which is, I think we've over the last part of this presentation so far, we've kind of looked at the numbers and prices and earnings and valuations, and kind of from a technical perspective, and looking at valuations. But another thing that we like to do is zoom out and look at the economy overall and some of the things that contribute to just our life, right? And one of the biggest things that we've talked about over this last year, one of the biggest trends has been inflation. So, Evan, talk us through this and other things that could impact the market and the economy over this next year.
Yep. So first of all, how did we get to where we are now? Inflation, because of a lot of different factors, inflation went through the roof. So what did the Fed do? The Fed increased the rates to keep inflation in check. So if you go back 2 years ago, inflation was the highest it's been in a very, very long time. Not uncharted territory, but highest it's been in a long time. And over the last couple of years, they've been tapering that down. You can see every couple of months when they have their meeting, dropped by a quarter, dropped by 0.5%, trickling down over the last couple of years. And now here we are today, where it's not as low as they want it to be, but we're getting close. So what are the forecasts for next year? The plan was to continue the plan we've been doing, taper, taper, taper. But with the Trump administration coming in, there are some factors that would lead to more inflation, which would then turn to the Fed and say, maybe we can't lower the rates as the plan that we wanted to. So just to show the fact of how inflation is going to go back up is because of these tariffs. The tariffs that Trump wants to put into place would bring them to the highest levels since the 1930s. That is
Wow.
a crazy jump in the tariffs that we would be charging. So tariffs would increase inflation because, hey, if we're charging Ireland an extra 20% on the goods that they're bringing in, they're gonna bump up what they're charging to buy it. So that would the end consumer would end up paying more, which would lead to inflation. So the expectation has turned to the rate is going to stay higher for longer, meaning staying where it is right now for a little bit longer. But what that translates to is the rates that we're going to get, returns we're going to get from bonds might not be as good as we intended a couple of years ago.
Yeah, and that's to just to illustrate here, I think there's such a misconception among, a lot of people, even people that understand finances pretty well. There's a misconception that when the Federal Reserve starts cutting rates, that means mortgages are going to get cheaper and car loans are going to be cheaper and things like that. And in reality, when we look at loans, when we look at debt, obviously there's different lengths of debt, right? You can have a mortgage that's 30 years, you can have an auto loan that's 5 years. And this rate that the Fed sets is really the shortest term. It's like what banks used to loan money back and forth, what your money market or high yield savings account is kind of based off of. But mortgages and longer term debt like treasury bonds, right? 10-year treasury bonds. Um, that's really uh, those are more based on where people are anticipating rates to be 5, 10 years in the future. And so what we saw here is when we started getting good economic news back, the Fed started cutting rates here, and so the Federal Reserve rate started dropping, and people got all excited. And you can see the 10-year Treasury and the 2-year Treasury started dropping here as well, because the thought was, oh, we're just going to trickle this back down over the next few years until we're at 3%, 2%, something like that. And that was the anticipation. Well, then the market stayed resilient. The economy looked really strong. It didn't look like things were softening. Uh, the election happened. It's looking like tariffs might be on the table. It's looking like some of that might be inflationary. And so now
I
the
was going to
federal
say,
fund
in comes Trump as the president elect,
right.
and now all of a sudden the rate market is what worried about inflation. So you see that reversal, right, of the
Mhm.
red line, even as the Fed fund rates are coming down, which is not usual.
Yeah, very unusual, actually. And yeah, and so this is going to be kind of a wait and see thing, right? It's looking like the Fed's probably going to hold rates where they are right now for a period of time. So we're going to have to see if these 10-year and 2-year start to level out as well and come back down the other way, or if they push through here in anticipation of higher inflation. Um, and that impacts a lot of things, right? It impacts buying costs, borrowing costs. It also impacts those of you that are in a more conservative portfolio using bond funds like the F fund and the TSP, or you're in a bond portfolio, with us if we're your investment manager. And as a lot of you have learned over these last few years, when rates are rising, that really hurts your bond funds, right? When rates are rising, uh, bond funds don't perform very well, because what that means is these bonds that we bought back here that we're only paying 2%, if you can buy a new bond that pays 5%, well, that one that's paying 2 isn't worth very much anymore, right? Because you'd rather have the 5% bond. And so the opposite happens when we're on the way down, and that typically is good for bond funds. But this is kind of an interesting chart here to show what we can expect from the bond market if it acts like it has in the past. And what this shows is wherever the yield is right now, we're around 5%. If you look at like a 10-year bond, okay. If you look at the last five, if you're about 5%, what is the annualized return then over the next 5 years? And it makes sense to translate. It's about 5%. So what this means is even if rates move up or down a little bit, this data is pretty tight here over a 5-year period. And when rates are at this level, it's looking like we can anticipate about 5% a year from our bond fund, which is, a decent rate over the long run. Okay. Now, if we broaden this out a little bit and we look at how stocks and bonds typically perform when rates start cutting, like they have, uh, you can see that in general, stocks over here generally perform well after rate cuts. Okay, there's a couple bad years in there. '07 was one, 2001 was one. And so, what this kind of shows us is if rate cuts are associated with a recession, which is what happened in 2001 and what happened in 2007, the market tends to fall after that. If we can cut rates and avoid the recession or avoid a large recession, the market tends to enjoy that and do well. So far, we're sticking right in here on this kind of upward trend, uh, which is the positive group here. Now on bonds, we've actually seen typically after rate cuts, bonds do very, very well, right? You can see every group here has been positive every time this has happened in the last, since the early, how long, how wait to go back here, the 80s. It's been positive every time. 2024, so far for bonds, this has been the worst rate cutting environment, or the worst performance in a rate cutting environment that we've seen since the 80s. Okay. And so
because the bond market doesn't believe it.
right. Yeah. Yeah, that's
They're
actually
not
that's a
being
great point. That's a great way to say that.
the bond market has its own brain and says, well, look, if inflation's higher, the Fed can cut right now, but who's to say, a year, 2 years, 3 years, the Fed's not raising rates again? So that's kind of the battle that you're seeing between the Fed trying to lower rates, but the market for bonds essentially having its own judgment on this, saying, wait, 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 we're not sold yet.
Yeah.
I my feeling is that the bond market will eventually fold and we'll see it play out like we normally have, but we've got to see inflation start to come back down before there is a reasonable belief that the Fed can affect long-term rates. And that's kind of just very interesting to see. It's like the first time we've seen after a first rate cut. Um, I guess in 2019 we saw performance struggle, but eventually was above that trend line there of zero.
Yeah. Yeah, and this is, we've over this last year we've mentioned the difference between the F fund and the TSP and the G fund, and how the G fund is, a good consistent rate payer, but if interest rates start coming down, it's just going to start paying lower rates. Historically, if interest rates start coming down, bonds start doing well. And so, we've given some input over this last year on to start including some F fund, not be 100%, G fund in a lot of cases in the TSP. Of course, it depends on your situation. But we've had some people question that, right? Like, oh, I'd move some money to F fund. It's not doing very well this year. And yeah, we're looking a little bit different than what has happened throughout history. And it's exactly because of what Neil said. It's the bond market not trusting that rates are actually going to come down. So we'll
A-
have our eye on inflation this year and see what happens.
And one thing that I think to point out, and this is our clients, this is folks that are, manipulating their TSPs, is like we tend as human beings to be very short focused, right?
Mm,
3 months feel like a decent amount of time to us. 6 months feel like a decent amount of time to us in our own lives. Many things happen within that time frame. But a lot of times in the investment world, you've got to really look at things like maybe not even in a year, maybe in a 2 year trend, right? So it may feel like whatever decision you made to maybe invest more in bonds might be not working or premature, and you may want to ditch that entire investment philosophy. But I think as you look, the data suggests that even though the first 3 months of that cut were, if you were to have tilted more in bonds, you would have been wrong there. Give it a little time. Give it a year, right? I think you're going to end up benefiting from whatever that decision is if you just give it a little time. you're never going to be exactly right. I mean, the best investment managers aren't exactly right, but if you understand the data, it's going to give you a better a kind of understanding for making these decisions on your portfolio.
Yeah,
So
absolutely. Well, and that transitions perfectly into this, our tips for investing right now. And and again, if you've been watching these, we share these every time. They haven't changed, and there's a reason for that, right? We think they're evergreen. One is maintaining a balance between growth and value, right? We're not saying, even though we showed this picture of growth maybe being overvalued right now in our portfolio, we haven't fully avoided growth. We haven't jumped all the way out of it just because we think it's expensive right now. We're still looking long term. We still think there's reason to be holding those companies. We just don't want to have all of our eggs in that basket when we feel like there's some risk to that. So we have a balance between growth and value. Um, we are trying to be very mindful of concentration risk and knowing that when you're investing in the S&P 500, 40% of your investment is in 10 companies. Okay? We're being mindful of that and understanding that we aren't being fully diversified by being in the S&P 500. So we're finding other ways to get diversified. Okay. We are becoming, much more open to including small company, mid-sized company. And I specifically say actively managed international funds here, just because it's like what Neil mentioned before. Even though we see some value in international markets, using indexes like the I fund and the TSP can be difficult, just because you take the bad with the good. In
yeah,
those types of indexes, it's tough to filter out some of those company or countries with political and other types of risk. So outside of the TSP, there's more opportunity in the international side, but you do have the ability to mix in some small company. You do have the ability to mix your F fund with your G fund. Um, and those are the types of things that we want to make sure we're diversified and not putting too much concentration in one area. So we'll wrap up here today, and say that we love doing these commentaries. We love providing value on our YouTube channel and sharing and educating in this way. But we also know that certain questions just can't be answered with YouTube, right? Certain questions have personal answers, and you need something that's related to your situation and when you're going to retire and your risk tolerance. And so that's why we offer the financial checkup. Financial checkup is an hour call. It's with me or Neil or Evan or one of our other financial advisors or coaches, and we can talk about just about anything. Right? We know a whole lot about the federal benefits. We know a whole lot about investing in the market, and we're happy to answer questions that you have and start planning on, uh, you know, are you allocated correctly, or do you have too much concentration in one area? Do you have tax questions on Roth versus traditional TSP? Taking Social Security, Medicare, any options like that we can cover in the financial checkup. And you can book that here. You can go to retfed.com/register or scan this QR code below. So one last reminder, we will not be doing a February commentary. We're going to be doing these every month from now on. So March will be our next commentary. We'll be emailing these out to you. And if you're subscribed to the YouTube page, which I highly recommend, you'll get notifications whenever we post new videos. So
every other month.
every other month is that, I sorry if I misspoke there. Every other
No
month
worries.
we'll be doing the commentaries. But Neil, Evan, anything to add before we wrap this one up for January?
The only thing I would probably just add is, like, we like to try this back to TSPs because so many people watch this on their TSPs. So, like, let's cut through the tape. What are we saying to do on your TSP? Okay, if you're trying to use this as such to get a perspective of,
Hmm.
I think the main takeaway here would be on a TSP is we're a little bit concerned about the C fund. White, it's got 40% in 10 stocks, and those are really pumped up in value. Your small cap index there over at the S fund is a better valuation right now than the C, than we've seen in 20 years. Although those companies are smaller, they are they are a little difficult sometimes during a recession because they're smaller, but you're getting better valuation. So you want to start to spread out a little bit. If you've held a lot in your C fund, spread a little bit out, maybe to your S. Okay, and the 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 jury is still out on the I fund. I think Austin pointed out correctly the insecurities that we have about promoting your I fund, because when we invest internationally, we do not use the index. Uh, uh, you know, you could look at the differences between really properly managed international funds versus just the index, and there is a far difference between those funds in terms of outperformance of the active, and a lot of that is just due to not including bad companies into that space. So there's a major discount going on in the I versus the C, but we're still not constructive enough to just promote the I. But if you have no I, maybe this is the time to take a little bit of a dabble there. And again, if you're holding a lot of G, maybe this is the time to take a little bit of a dabble on the F. Because if these inflation concerns are not validated and inflation maybe scared us here. Trump doesn't go full tariff. Maybe he tries and the market reacts and he lets the tariff go. Then we're probably sliding down on interest rates. The F will rally in that case, and things start to look good on the bond front for sure. So don't be scared out of your F fund at this point. I would maintain that F exposure if you have it, and maybe even consider adding to it from your G fund. That's my
Great.
closing arguments for today.
All right. I think I don't know if we can top that, so we'll go ahead and end it there. Thank you everyone for sticking with us. This was a little bit of a longer commentary, and check back in. Make sure to subscribe so you get our videos. But thanks all. We'll see you next time.
All right. Sounds good.